Hello and welcome to Stockwatch Live. Now, sugar is the modern day nicotine and a key target when it comes to tackling the UK's obesity problem. We have one of the highest obesity rates among developed countries, and children's diets of soft drinks have been identified as a major culprit. So, in 2016, a UK sugar tax was announced by then Chancellor George Osborne, adding 18 pence a litre to the price of drinks containing 5 grams of sugar per 100 mils and 24 pence on more than 8 grams. However, the soft drinks producers were quick to respond, and rather than accepting the burden of the tax lying down, they simply reformulated to new, lower sugar versions. AG Barr reduced the sugar in its famous Iron Brew soft drink from 10.3 to 4.7 grams per 100 mils and made similar changes to other drinks in its range. So much so that 99% of its products are now exempt from the sugar tax. Who knew it was that simple? It seems that as a result, fizzy drinks companies, once the villains of the piece, were suddenly seen to be doing the right thing. At the half-year stage, the company said its volume share of the soft drinks market was up around 15%, with a pleasing performance from Iron Brew. Overall revenues were up 5.5%. And with sales in the bag, AG Barr shares have soared to an all-time high of £8 plus. And that was an even greater achievement when you factor in the carbon dioxide shortages that also hampered the fizzy drinks industry. Despite reporting a fall in first half profits from just shy of £19.5 million to £18.2 million, AG Barr maintained its expectations for the full year. The company said that while further regulatory intervention was on the horizon in the wake of the sugar tax, it was confident that momentum would continue. Our strong and flexible business model, our portfolio of differentiated and growing brands, and our well-invested and efficient asset base gives us confidence for continued profitable growth as we enter a new financial year, the company said. Tuesday's full-year results will tell us whether that confidence has been rewarded. Now, often dubbed the posh tonics company, Fever-tree Drinks is another fizzy drinks group that has investors keeping a close eye on it. In this case, it's not about the sugar, but whether the trend for gin has started to lose its fizz, which in the case of this leading mixers brand would be a serious worry. Fever-tree, which reports full-year results on Tuesday, has dismissed any notion that sales have gone flat. In fact, thanks to strong trade in the G&T loving UK, Fever-tree raised its full-year revenue forecast to £236 million, 39% higher than the same time last year. That proved to be just the tonic for the shares, which climbed 15% higher on the news. The ongoing debate, though, is how much further the premium-priced tonic maker can grow. That has left some investors uncertain, which has been reflected in the share price. Now trading around £27.50, Fever-tree shares have come some way back from their peak when they were touching £40. It's true that Fever-tree has turned in a sparkling performance since coming to market. It trounced the long-standing competition, with the likes of Schweppes and Britvic being relegated to the sidelines, as Fever-tree tonic water became the go-to. And in the 3 years after it floated in 2014, its annual pre-tax profits rose 2,150%. But, as the saying goes, all good things must come to an end, and the big question on investors' lips these days is whether the UK has reached peak gin. The US is being touted as the new growth area if that is indeed the case. Fever-tree has started running its own business stateside and reported 21% revenue growth in 2018. But as yet, gin is a much less popular spirit in the US than in the UK. And there's also a trend there, particularly among those 35 and over, to drink their spirits on the rocks rather than with a mixer. So while the US drinks market may technically be potentially larger, it may not turn out to be as lucrative for Fever-tree. Analysts are still sweet on it though. A new miss, they're confident that the brand could have seized on a substantial growth opportunity in the US, it says, having brought its American operation in-house and signed a deal with the continent's largest wines and spirits distributor, Southern Glazers. And Jefferies analysts still assert that Fever-tree is a unique asset. For its part, Fever-tree is also talking a good story and maintains that the UK market is still growing. In January, it said its annual performance would be comfortably ahead of full-year expectations, led by exceptional growth in the UK. Tim Warrillow, co-founder and CEO, went on to say that the company was going into 2019 very well positioned, and he was optimistic about the long-term global opportunity ahead. That confidence prompted a flurry of broker notes. Deutsche Bank, which had only just reiterated its hold rating and cut its price target from £30 to £26, promptly revised that back up to £28. RBC Capital Markets repeated its outperform investment rating, but cut its price target to £34, while Berenberg reiterated its buy rating and has cut its price target to £39. One other sector that's all too familiar with market disruptors is the advertising industry. Cue full-year results from M C Saatchi on Wednesday. A year ago, the London-listed advertising group, whose roster of clients includes Coca-Cola, NatWest, Heineken and Reebok, brushed off concerns about traditional agencies losing ground to Google and Facebook. It reported double-digit revenue and profit growth, with sales up 12%, helping lift pre-tax profits by 37%. At the half-year stage, the company asserted that creativity, and I quote, cannot be automated, as it unveiled a 13% rise in statutory pre-tax profits to £11 million. That was boosted by a strong performance from its UK operations. The sport and entertainment division was continuing to trade particularly well, it said, and earnings had grown in all its geographic markets, apart from the Americas. The hiring of its first creative director this week, following swiftly on from the sale of its remaining 25% stake in UK media agency Walker Media for £25 million, has some thinking developments could be afoot. Well, that's all for this week. For coverage of the company's reporting in the week ahead, go to the Markets and Insights section at fidelity.co.uk. See you next time.